Cloud Returns podcast covers all types of software investing, whether seed, venture capital, growth equity, private equity, debt, and even the public markets. Well, I'm excited to welcome Dave Yuan from Tidemark to the show today. I've long admired his content. He's a very well-respected investor. Before forming Tidemark, he was an investor at TCV, where he was named to the Midas list. He's been on the boards of various excellent software companies. And one thing I've also admired about Dave is when he set up Tidemark, they do donate 10% of their profits to the community. And as someone with causes that are dear to my heart, I recognize what that type of leadership takes. And I think people should, acknowledge people who make a commitment like that. So Dave, I want to commend you for that. And he did not ask me to say that, by the way. So I'm surprising him with this, but with that acknowledgement, do you want to tell folks a little bit more about yourself and Tidemark?
Yeah. Thanks, Matt. Thanks for having me. I really appreciate it. I also appreciate the acknowledgement. We don't talk about the foundation a lot, but it is a core motivation for what we do. It makes the red eye to Chicago, which is probably the worst flight on the planet, chasing deals a little easier to do, knowing it helps other folks. So maybe a quick background on me. I've been an investor since 2000. I got my start during the first .com crash, right in time to catch a bunch of falling knives. I was first a buyout investor and then joined TCV in 2005, was there for about 15, 16 years as a growth equity and crossover investor. We started Tidemark in 2021. We're a growth equity firm. We're trying to invest in category leaders that are both fundamentally sound and aligned to long-term thematic trends. I think that's pretty straightforward. I think maybe the distinctive part is really two things. The first is we kind of don't care who the shareholders are. We don't care if there's a fancy VC involved or it's bootstrapped, but we don't care who the shareholders are. We don't care if it's a minority deal or majority deal. We just want to work with the best, and the best as expressed in terms of product excellence, go-to-market advantage, and companies that are winning the market. I think the second thing that might be a little different is we've chosen to open source a lot of what we do. So as Matt and I got connected, it was really through some of the frameworks that we've written on vertical SaaS and horizontal applications. And so we really invest a lot in those frameworks. We put it out there for everybody with the idea that if we service the community first through ideas and then through coaching, so we have a big curriculum that we're launching, through data in terms of benchmarks that we're also launching, then we'll just build this great community of entrepreneurs. And at some point in time, those entrepreneurs will want to raise money. Hopefully it'll be enough each year to build a very strong investment practice off of. And that's what we're trying to do here at Tidemark. That's the ethos of the firm.
And then it always sets these episodes up well for people to just have some context. Like, what are your investment criteria? And I know you touched on some of them.
Yeah, I touched on the qualitative. I think the other aspect is we are generally a late stage investor, and late stage means anywhere from mid to high single digits ARR on up. And again, we can invest in terms of minority deal, majority deal, even times in public companies. So we really are quite agnostic. We just want to work with the best.
In researching for this cast, I've seen you describe chasing certain companies. And what is something that really gets you excited about a company or a founder?
Yeah, I think every company's a snowflake and every situation's a snowflake, but it does start out with those three things I mentioned, which is a opportunity or right to go win a category. And that usually is derived from either a differentiated product, something that changes the both customer experience or the business model for a business, or both, hopefully. So a true category leader, a business that's aligned to long-term trends, and just a fundamentally strong business, unit economics, good return on invested capital. Okay, so if that's the high level sort of backdrop, what we look for in addition is we start out with really the product strategy, because in technology, certainly in software, we believe that is the heart of the business. And so we're looking for companies that occupy what we describe as a control point. A control point can be used both in vertical SaaS and in horizontal applications, but it's the core heartbeat of your customer. It's the system that has the most data gravity. It's the system that has the most workflow gravity. The reason why we care so much is because it not only has really high retention rates and great financial metrics, but more importantly, allows you to sell additional products to that same customer. And that, to us, is the heart of what makes a strong business model. It drives retention rate to some extent. It drives net revenue retention rate, which ultimately has a very strong correlation to both growth and profitability and multiple, which obviously those three things make for a good investment. So I talked a little bit about the product strategy and the product situation. I think the other piece is the team. We're looking for founders that really understand either something that's changing in their customer, something that's required by the end customer set, or something that's changing in the economics of the industry. We're looking for folks that are real first principle thinkers rather than using heuristics, and people that speak plainly, people who speak directly. Like, you need to be clear-eyed as a board, as a group, as shareholders together, and hopefully make decisions with data and rationality. And I think within vertical SaaS, which is a topic I think we're going to cover a fair amount today, the other piece to this is really this strong, I describe it as clarity and focus around sequencing. We'll get into it, I'm sure, but if you occupy the control point, you have a wealth of opportunities. You can expand through segment, you can expand through product offering. You can actually sell to your other stakeholders, whether that be your customer's customer, your customer's employee, your customer's supplier. As a result, you have to be really surgical about how you think about product prioritization and how you think about sequencing the various different opportunities that face you. So hopefully that gives you a texture of what we're looking for. We don't see it that often, but when we do, we're pretty fierce in terms of chasing these companies.
Interesting. And I know you've written a lot on the product side, and particularly the multi-product aspect of that and all of these frameworks. And just the other week, I saw a rant from another investor about companies over-investing in R&D, at scale, and that they should be more disciplined. And it made me think, vertical SaaS has an interesting dynamic where you have, a very specific customer base, and perhaps you can be more precise in your product development, your R&D spend, because you should be close to your customers. Do you have any feedback there on kind of just overinvestment, underinvestment, risk levels and product development within verticals?
With vertical SaaS, there tends to be higher product market fit because you're not solving for multiple personas. You're not solving for multiple industries. You're solving for a specific industry and oftentimes a specific persona. So you can build the product to suit. And so you should see stronger product market fit. And perhaps your first product, depending on its intensity, can actually be a product that you can build with fewer resources. That said, vertical SaaS companies inherently are multi-product companies. And so for most end markets, and every vertical is different, right? Every vertical has a different size, fragmentation, profitability, and turnover. But for most verticals, you need to oftentimes think about your second product as you're building your first. And again, this delicate art of sequencing is the issue. Where I thought you were going with this was the general idea of overspending on product. And I think there's a lot of truth to that, in the sense that I think there's certainly a truth in terms of misallocating resources, whether you're over or underspending on product, because inherently it's a really hard problem set to really think about return on invested capital in product spend. We spent a fair amount researching. We're kind of in market right now thinking through this issue. But if it's hard to measure, then obviously you'll see over and underspending. I do feel at times that if you throw too many resources at a product issue, particularly if you aren't precise and surgical about your product sequencing, if anything, you can slow yourself down. So I do see many circumstances where there is overspending. On the flip side, in markets like 2002 and 2003, and we'll see what 2024 holds, I also see boards and companies cut back at just the wrong time, right? As you're starting to decelerate, as you get a push to move towards profitability, product oftentimes is the first to be targeted because of that lack of direct relationship in quick succession between investment and revenues. And I think that can be a mistake. Oftentimes when the market slows down, the right thing actually is to invest in your core IP, which is your product. And so that when the market returns, you can actually come out faster than how you entered.
Interesting. And for one, you're one of the rare people I've heard in software talk about return on invested capital. It's just amazing in this industry that how little you see ROIC in equity research or various venture capital thought pieces. But it ties very closely to the sequencing. And I think people could learn a lot here around what does sequencing look like? What's the planning horizon? What is some work you do with your companies, right? Like, are you setting out a 2-year plan, 5-year plan, 10-year plan? Like, just what does good sequencing look like?
Yeah, it's some combination of the market structure. So the market structure being size of market and fragmentation and competitive dynamic. Some part about the economic realities of your current go to market and your overall business. And then just what's your time horizon and aspiration. So let's unpack those three things because it's sort of very high level platitudes. In terms of market structure, our belief is if you own the control point, if you own that key product, and there's usually one or two of these product sets within a small business, it's your front office and your back office solutions, you really want to go capture the high ground pretty quickly. And so as you think about spend on location versus product, on the margin, you should probably just go try and acquire locations if the economics are good and the competitive landscape is relatively open. So go win the high ground first. And then thereafter, think about offering that second, third, fourth, fifth product. That assumes you have strong unit economics on that first product. And so if that's not the case, and you actually have to think about incorporating attach on net take rate on payments or lending or a second or third product, well, that's just the economic realities of your business. So you need to move up the product investment earlier. But once you seem to have gotten strong traction, repeatable go to market, and you're starting to really tip the market, then I do think you start thinking about second or third products. And that happens because these markets tend to be smaller. Product market fit tends to be bigger. And there's also a branding flywheel within a local market associated with vertical SaaS. But once you start tipping market, you think through the first principles. What are you trying to do with that second product? Are you trying to perhaps solve an issue in retention? And so you optimize to stickiness. And I think some of the control point concepts around data gravity, workflow gravity, account gravity can help you prioritize. Are you trying to max for economic value, solving for ARPU and attach rate, right? That's a whole separate set of issues. The third thing, and this is when you start really dominating a market, are you solving for TAM and extending through the value chain? Those are two slightly separate things, but we'll take them all at once, which is you think a little bit less around your near-term economics and you think about your long-term runway. Because ultimately, over time, even if you take a short-term hit to your near-term economics, if you move to slightly less initially profitable space, over time, you're going to capture more of the TAM and ultimately maximize your long-term profitability. So hopefully it gives you some texture. And then, then you go into the, third order calculus. Like, so for example, if you're thinking about staying through the value chain, well, there are different products you might offer if you want to get close to the consumer, and different products still if you want to get to the employee or the supplier. So we do, not to plug our writings, but we do pull this apart in like 20 essays in the Vertical SaaS Knowledge Project, which is on our site, that if you want to go into detail, there's some thoughts there in some of that writing.
And then tactically, how close are you to the customer in this planning process and sequencing? And just tactically, are you doing surveys like, go to 100 customers? Do you guys want payments? Do you guys want payroll? Like, is that something that you've seen your best companies do, or do you not need to do that?
Yeah, I mean, look, you should be all over customers for a whole bunch of reasons, and most importantly, your product strategy. So, yeah, 100%, Matt. The other ways you can get a sense of this is you can build into some of your systems. I've seen companies in their Salesforce CRM, they will actually label and tag adjacent products that not only that touch your core product, but also their renewal dates. So then you're sort of starting to plant the seed around when these sales cycles come up and when you can cross attach. But yeah, think about in sort of separate frameworks, we think about a handful of things, right? If you think about the second or third product based on the priorities that you mentioned, you look at, follow the workflow, right? So if your core product drives a workflow from A to B, well, look at products that sell to B, the B user within your customer. Follow the money, which is a specialized version of a workflow. Data enriches data. So oftentimes you'll see a second product use the data of the first product to enrich it or to present a different way. That's a specialized version of single source of truth. If there's like a canonical data set, which you have multiple users or multiple functions or multiple views of, well, that's a great way of selling a second, third product that leverages that same data set. these are the type of heuristics you can use in addition to asking your customers and looking at what's currently integrated and what's installed.
Interesting. And in the show notes for everyone, we will include Dave and his team's various essays. Like, they're really thorough, really comprehensive on multi-product and all of these considerations. And then, given the topics of the day, what are your viewpoints on AI as it relates to vertical SaaS? Is it a threat, neutral, or an opportunity?
Yeah, I think if you own the control point, right, you're the system record system engagement, you own data gravity, so you own the most important sets of data, you have workflow gravity, and you own the key workflows. I think vertical SaaS actually is reasonably insulated from the threat of AI, or better yet, they have a bit of a moat and a time frame to innovate on this front, right? And if anything, AI, if they're not asleep at the wheel, is a complement and an opportunity, not a threat. If you think about it, a lot of the vertical SaaS companies that we invest in are great workflows, and they help companies not only run their business, but in some ways divide the work, right? Like Carbon, one of our portfolio companies, for example, a core part of their offering is a task management system. Well, if you're a task management system, you can shift from managing the business to actually helping your merchant do the work. And each of these tasks, they have different vulnerabilities or different applicabilities for things like Gen AI. Well, if you can parse out the tasks that are most suited for Gen AI, bring it back in the workflow, well, that's a really seamless way to get the work done the way you always have been doing it, but then infuse software and automation into that workflow for more efficiency. The nice piece is because you own the workflow, you can also put a human at the end to be a human in the loop and to be the last line of validation if you need it. So I do think a lot of these vertical SaaS companies that occupy a control point actually can really benefit from AI. The risk, if they're asleep at the wheel, though, is if AI companies essentially integrate into these control points, they get purchased in a customer account, they have lots of VC funding, they do things like deliver revenue to a merchant, and a merchant's, like all small businesses really thrive on revenue, and so they'll really double down on native AI offerings that provide revenue. Well, you can start to see these native AI companies landing wedges and starting to surround a control point or a system of record, and over time take away more and more of the functionality. So you can't be asleep at the wheel as a vertical SaaS company. You have to take not only the opportunity seriously, but the threat seriously.
You're giving an interesting example with your portfolio company around task management, right? You're giving a framework to organize projects or tasks. That's traditional software. But in an AI world, you can also be actually delivering the outcome and doing the work, or have a human overseeing the work actually getting done. And that strikes me as you have to have a radically deeper understanding of the work and the workflows compared to traditional software.
Yeah, that's 100% right. If you think about these businesses, a lot of these businesses really view their workflow as proprietary. This is how we get things done, right? This is who we are. And so to think through application built on an LM to basically conjure up a workflow for a customer, I think it's possible, but even the trust and the certainty associated with that workflow, some of the UI nuances may be completely foreign to the customer. So you do have a challenge around adoption. And so these Gen AI companies, native AI companies that are trying to take the entire workflow, of course it's possible, but that is a pretty big lift. On the flip side, I think some of these end-to-end all-in-one operating systems for merchants, well, they already have a lot of the workflows in their system, and their ability to AI empower, just given all the infrastructure build that's occurred over the last 2 years, actually can be greater. They may have a higher probability of success if they're vigilant and aggressive than the native AI company trying to disrupt the entire workflow.
And do you see AI unlocking like software resistant markets by just fundamentally delivering such a better experience that, certain pockets of verticals that have been immune or very, very late adopters of software, start becoming open to you?
I think we're already starting to see that, right? I think even just the UI capabilities in terms of the chat interface, I think I think what you're starting to see, I mean, if you're on Twitter, you're starting to see a number of customers actually self-credentializing by promoting AI products just as a part of their own desire to align themselves to this new trend. And so I think you're starting to see even old line industries get interested, and they'll either show up in terms of neat new features or they'll just do the job for their customers. Both are effective ways of driving adoption.
This is interesting. And, we are still so early and it's so hard to forecast, but it's fun to pontificate. And then I wanted to just transition to like the SaaS capital markets, investing valuation. As someone who's invested in software for a while myself, I've always looked at vertical SaaS as having kind of an inherently narrowing funnel. Like there's only so many markets, only so many setups where someone achieves scale. But these are absolutely beautiful businesses for all the reasons you outlined in terms of control points, retention, the value they bring to their customers, right? They're absolutely beautiful businesses. And you very well might end up with like a supply demand imbalance, like a huge universe of private capital investors and a relatively narrow universe of scaled vertical SaaS companies. Like, do you see that dynamic in the marketplace, or am I kind of overstating the imbalance?
I think, like all technology markets, there's an ebb and flow and there's a fashion, right? 2021, no one really wanted to invest in a vertical SaaS company. The TAMs were too small. Even the biggest TAMs in the verticals, they wanted to go after disruptive infrastructure. Those are massive markets, and so on and so forth. And so I would say, all things being equal, vertical SaaS was more ignored. In today's market, I think they find comfort in terms of really understanding the end demand dynamic. Small business has been relatively stable in terms of demand versus big enterprise. And so these feel like safer bets. There's a little bit of the pixie dust with AI. And so you're starting to see capital inflows. I think of all technology markets, capital comes in and capital comes out. And ultimately we want to be long-term investors in the markets that we think are driving real innovation, driving real value for both customers and shareholders. I will say that the thing that we really like about this market is there is no one vertical SaaS market, right? These are software companies selling to restaurants, to dog groomers, to beauticians, to hotels and lawyers. And so those end markets can be quite different. If you're in a really small market, you shouldn't really venture fund that. You shouldn't raise big gobs of capital because you don't have a need to build a massive sales force to go cover the market. You'll outstrip your market. You'll burn through your leads too quickly, right? And so there isn't great use of capital, and therefore there isn't great returns. On the flip side, though, there can be ample opportunity for private equity, secondary recaps, M&A financing, and capital efficient oriented minority venture investing. The DNA we have here at Tidemark has some components of private equity to invest very deeply into some of these small markets, but then also the venture DNA to invest in some of the bigger TAMs where it does make sense to, as we were chatting earlier, raise a fair amount of capital, go capture the high ground, really lean into S curves of sales capacity to go win locations, and then cross-sell ARPU over time. You forward advance your effort in locations by raising additional capital rather than moving to monetization earlier in your life cycle. And that can prove out to be very successful.
And so if, along these lines, like a scaled or a vertical SaaS that has achieved some capital or achieved some scale, has some optionality around capital and how they fund themselves. And I think you were touching on it there. Like, what are some frameworks where a founder or a board might look at, should we put our foot on our accelerator and raise more capital, or should we pursue a more capital efficient path?
I'm trying to think about a framework that doesn't resort to fairly basic finance, but you start out with return on invested capital. I think that's driven by return on your go-to-market spend and your product spend. And I think probably the more interesting answer gets into this idea of what's the market structure, how much headroom is there, and as you start tipping a market, do you want to continue to try and win locations and high ground of control points, or do you want to start flexing into ARPU, which in some respects is inherently monetization, right? And so those are kind of the two toggles that you're working with. And based on the competitive dynamic in the TAM, you may decide that we're going locations for a really long time. And so let's go raise a ton of money. And even if our unit economics are very strong, it still makes sense to invest in more sales capacity because it is a competitive market and we want to land these accounts because once you land the control point, you have an unfair right of keeping them and selling them more. On the flip side, again, you may be in a smaller market where rather than raise financing from outside capital providers, you raise it from your customers by selling them more product. So I think those are kind of the two big inputs.
Interesting. And then vertical SaaS has a very long horizon. Like the growth stories can be like 20, 30 years to play out. And that has some interesting implications for both founders and then also like the private capital markets, right? Like how do you look at a business and how do you remain excited or retain or structure transactions? Like, do you see any unique dynamics? And is that how you thought of Tidemark in terms of minority investing? Like, just horrible setup to that question, but something along the lines of long horizons.
Yeah, no, I feel you. I think I know where you're getting to. And, I got a great example, right? So the superlative vertical SaaS expression is a company that sells to multiple stakeholders, right? So if you take CCC as an example, they started out selling claims management software to auto insurers. And once they got some great success, then they started selling to auto body repair shops that served auto insurers. And then subsequently, they started selling to parts dealerships that were selling parts to the auto body repair shops. And so that's a business. It's a beautiful business, right? It creates workflows that stretch across 3 layers of the value chain. They do great things for the consumer, their customers, all participants in the value chain. That's a really hard market position to create, right? Because at some point in time, you're trying to sell software to both sides of a transaction. And by the way, your software actually can determine the economics of each participant. And so you have to be able to build trust with both sides that you are always going to do the right thing, that you're always going to be transparent, and that you aren't going to put your thumb on the scale for one stakeholder or another. And that requires a much longer term horizon because as you start to scale, the natural temptation is to increase monetization, and you increase monetization by essentially charging one stakeholder to put their thumb on the scale. And so you need a CEO and founder and product oriented and industry visionary like Gatesh, the CEO over there, to play the long game, to be the trusted party amongst all these different stakeholders. So I think that's right. I do think for the businesses that are going to build multi-level, multi-generational platforms, you do need patient capital. One of the things at Tidemark we created was an ability and a flexibility to extend hold period in our investments. We won't do that for every deal, but for the ones that we think will continue to compound for a really long time, we want to play with them. We want to stay with them. We want to make money with them and help them sell to multiple stakeholders. So I think it's a really astute point. It's kind of a hard concept because there aren't that many companies that have done what CCC and a handful of others have done, but it is the long-term opportunity.
And when you're making investments, like how do you screen for someone's fit for long horizon? Like, does this founder or CEO or management team have the interest, the stamina, to attack a market like this for a long period of time? Is that something you focus on at the investment stage?
Yeah, I would say it's not the easiest thing to get a sense of, but in some ways, like there's no Excel spreadsheet you can put a bunch of variables in, but like you can tell, you can feel it, right? It's how does it express itself? It expresses itself in terms of passion for the customer, passion for the problem. I've heard founders talk about passion for workflow. As corny as that sounds, like if you dig into it and you test and it's true, like that's a real thing, right? And then you see it with their actions, right? Just as I described some examples where people were playing the long game, you can also see people playing the short game.
Yeah, I can relate. And these things are hard to suss out, right? Everyone's on their best behavior. And, you go take people out to a steak dinner, right? Like, how much do you really learn? And anyone can put on a good show. But the underlying passion needs to be there for particularly for these markets, right? Like if you're going to be selling into restaurants for the next 15 years, right, you better like selling into restaurants.
Yeah. I take the flip side of that, which is you talk to a vertical SaaS founder, and man, they glow when they talk about their customers. And that is one of the cool non-monetary parts of this end market, which, if you watch these ads for a vertical SaaS or SMB software company, it's always a picture of an owner at the beach managing the business by phone. And it's that sense of empowerment, because these are really tough jobs, and these are really tough small businesses to run. And if you can make someone's life easier, particularly if it's making their lives easier running a business that is their access to opportunity, it's how they pay for their kids to go to college, it's how they save up for retirement, that kind of thing, it's pretty awesome. So we talk a lot about the tells as to who's going to be short-term rented, who doesn't have the fire. Like, I think generally when I meet vertical SaaS founders, it's the opposite. The fire kind of comes out in spades.
And, another advantage of what you do is you kind of have an interesting window into like all these pockets of the economy, right? Like how auto claims shops work, how restaurants work, how accounting firms work. And it kind of gives you just an interesting window into how, people live and work. It can be fascinating. And I think you were hitting on that, some of the, how people are at the beach getting this stuff done.
It's a fun gig. It's a really, really fun job.
Interesting. And we'll just do a little rapid fire here. These are always fun. Robert Smith from Vista had a famous quote to the effect of, software tastes like chicken, 80% of it's all the same. Do you agree with that or have a take on that?
I think there's definitely a lot of pride and recognition, but each one of these end markets is totally different. Each entrepreneur is totally different, and the journey usually is quite different. So I think pattern recognition balance is fine, but part of the fun part is every one of these companies is a snowflake.
And what SaaS company do you admire the most?
I've been fortunate to work with a ton of great companies. I think of really archetypes for different models. So, if you think about big TAM vertical SaaS, Toast is in restaurants. And if you look at the NIC codes, restaurants is one of the biggest TAMs out there. And, it's over a billion ARR. And then what they've done is nothing short of remarkable. We talked a lot about CCC in much more of a multi-stakeholder context. If you think about horizontal SaaS and follow the workflow, ServiceNow has been an amazing business. Single source of the truth. We invested in this business that maybe people are less aware of, but it's a beast. It's a business called OneStream, where you're building different views of the same set of data, and that data happens to be your most critical data. So it's just an amazing business. So I don't have necessarily a favorite, but I just love seeing these businesses push the bounds of what they can be, and trying to put a name to the pattern and just the stories and the journey with them.
Interesting. And for everyone listening, in the show notes, we'll include some of these case studies. They're really well done on some of Dave's favorites there. And then what are some learnings from starting a new fund? Like, what's been a surprise? What's been a challenge? Anything you're willing to share?
I would say that it's been a lot of work. I mean, that wasn't a surprise. I kind of knew what I was signing up for. I would say the surprise has been like how much I've liked the work. It's really cool to basically start something with a team from a blank sheet. And we've tried to be fairly intentional, maybe too intentional at times. Maybe we should have just, gotten certain things done and not worried about it apart most of the business. So that's been great. I have a lot of empathy for founders. I think I always did, but more so now. And particularly in that 0 to 1 moment where you both have to and want to do everything at once, right? LPs want you to hire a team, source deals, do deals, raise money all at the same time to show that you can do it. And so you have to do that. On the flip side, like, to be a great firm, you need a community. You need to know how to source. You need to unpack companies, add value to companies. You need to be in the flow. Like, you got to do things all at once. And there's a magic to sort of standing it up all at once. And so I think most investors find themselves telling the entrepreneur to focus, do one thing well, and really sequencing it. So maybe I'm kind of discrediting my earlier discussion, but like, I get why you want to chase it all. I get why you feel like you need to chase it all. And I think that's been a really interesting part of the journey.
Interesting. And so you really feel like you relate to entrepreneurs better as a result of doing that?
I mean, I don't want to overstate it, right? Starting an investment firm is certainly not nearly as hard as starting a SaaS company or a manufacturing company. But yeah, in my own small way, I feel like I've gotten a spoonful of the initial go.
Look, it makes perfect sense to me. Like even just operating Cloud Ratings, which is very nascent, I'm a bit of an operator, and it's changed how I look at companies. Right? You just have a different appreciation for things. And speaking of doing many things and getting things going, you're launching a series of vertical SaaS benchmarks. Do you want to share anything more about that?
Yeah. So one of the first things that we did when we started the fund is we wrote this framework that we've been chatting about, the vertical SaaS knowledge project. And the idea is like, here's some both frameworks and case studies of how you go from a control point to expanding your offering and extending through the value chain. Well, what we really realized early on was that caught a lot of interest and created a lot of inspiration and goodwill, but it was falling short in terms of really helping builders both execute and implement these strategies. So then we launched something we call the VSKP Collective, which is a great operator with a group of 15 to 20 non-competitive operators of great vertical SaaS companies, all talking about the key functional aspects of winning. So onboarding, pricing, go-to-market, so on and so forth. The expansion paths, how to both implement payments and maximize attach rate and monetization, lending, payroll, ads, you name it. We're going to go further into extension to the supplier and the employer, the consumer side. And then the final piece is as you mentioned, we're working with 30 VCs, Stripe, Gusto, a handful of other great service providers to vertical SaaS companies to launch a benchmarking series. As we were talking throughout this discussion around sequencing, there's frameworks, there's earned experience and advisory services that we're offering, but then we also want to provide data. So if you're point of sale, if you're a control point of sale, on average, what's the first expand product you launch, and then what's the attach rate and monetization? If you're a channel manager, if you're ERP system, what are the paths? What are the sequencing that's out in the world, and trying to apply real data to that? So we're in market right now, and hope to have a great set of benchmarks in the next couple of weeks.
Awesome. Well, we'll include the survey in the show here, but that sounds awesome. You know my content. I'm going to go crazy for this type of stuff. And, there's a huge gap in it. There's no shortage of horizontal benchmarks. And for the level of granularity you're talking about, I can't wait to see that. So, look, this has been a great episode. Is there anything else you want to promote at all about Tidemark, or should we just wrap it up?
I think we're good, man. I really appreciate the conversation and really appreciate all the support.
Thank you. I'm honored to have you, and thanks for the time.
All right. Take care.